Hey, hi chartered, hope so you are all doing great. Welcome back to our channel. Today we are diving into a fundamental valuation metric that's not just essential for the students pursuing their careers in CA, ACCA, CS, CMA, BCom, CIMA and CFA, but also for evaluating stocks. The market value to the book value per share, or the PB ratio, price to book ratio. We will be taking a closer look at what it is, how it is calculated, and what actually is the book value per share, and why it matters in assessing the company's financial health and investment potential. So let's get started. As the name suggests, the formula for this ratio is quite simple. Market value to book value per share, or the PB ratio, popularly known as the PB ratio, price to book ratio, is simply nothing but the market value per share, that is the MPS, and then we divide the same by the book value per share, that is the BVPS. So basically today we will be looking at what actually is BVPS. MPS is basically the stock price. The stock is being traded at a price in the stock markets, right? So the price at which the stock is being traded, the closing price of the stock, is what we call as the stock price or the market price per share. But what actually is the book value per share? Let me just show you. Just a second. So this is money control, right? Today we will be looking at a company, say for example the highest priced company in India so far, that is the MRF, Madras Rubber Factory, I guess. So currently the MRF's share is valued at 1,08,542 rupees as on 25th August 2023. So basically Saturday, Sunday is off in the Indian stock markets, right? And let's have a look. We will be going to the financials. Over there's an income statement, there's balance sheet, cash flow, and the financial ratio. So if you look at the financial ratio, there's yes, over here 2.42 to 1.96. The price to book ratio, that is the market value to the book value per share ratio for the MRF's share, has increased from 1.96 to 2.42 within a span of 1 year, from March 2022 to March 2023. So basically what actually is the book value? Let's have a look. So looking at the balance sheet, if we have a closer look, if we take a closer look in the equities and liabilities side, all the figures are rupees in crores. Let me just screenshot the same and I will be attaching it to just a second. Right, so basically if we have a look, so the equity in the equity and the liabilities side, the share capital of the company in rupees in crores, over here it is just rupees 4 crore, right? So where's the real cash that the company is holding? So the real cash lies in the reserves and the surplus, and that is 14.703 crore in the year 2023, and in the year 2022 it is 14.027 crore. So basically share capital and reserves and surplus together, they constitute the book value, or popularly that we call as the shareholders funds or the net worth. Okay, so what is book value? Book value is the total of the share capital and the reserves and surplus. Okay, and what is book value per share? So basically what we do is we take the total book value and we divide it by the total number of the shares outstanding. So the resultant figure is the book value per share. Okay, so can we use the book value per share as and net worth per share or shareholders funds per share synonymously? Yes, we can, but the popular term that is being used in the markets around the world, that is used by the various chartered curriculums, I would say so, is the book value per share. So what is book value per share? It is nothing but the net worth or the shareholders fund. One is the same thing. These are all the synonymous terms, right? So basically what is the PB ratio? It is the ratio showing the relationship between the market value and the book value of a stock. Market value and the book value of the stock. Okay, so now comes the question, how is this ratio used by a fundamental analyst? the person who is fundamentally analyzing a stock, or we can say by an investor or a value investor, how does this ratio affects his decision of choosing one stock over the other. So basically, when we say that the PB ratio, or the market value to the book value per share ratio, is I would say low. In case this ratio is low, okay, it might suggest that the stock is undervalued, potentially representing or presenting an opportunity for the value investors. So the value investors or the fundamental analysis, they target a stock that is having a lower PB ratio. This is a general phenomenon because they believe that the stock is being undervalued in the sense that the as compared to the sector, the price of the stock in relation to its book value per share is lower. A lower PB ratio basically represents a lower MPS but a higher BVPS. So the ultimate wealth is in the book value per share. We all have seen it is the total of the share capital and the reserves and surplus, right? Basically the retained earnings, right? So the real wealth, the real money lies in the book value per share, and since it is undervalued, it means that the book value per share is higher in comparison to the market price per share. So this basically gives an indication or gives a hint that the stock being traded is currently undervalued by the value investors, right? Conversely, we can say that a lower PB ratio might also be a signal of that the company's prospects are not that future prospect, the company's future growth prospects, rather they are not that positive as per the needs or the wants, I would say, so of the value investors. In such a case, they might be undervaluing the stock, they might be undervaluing the stock of the company. So there's a bonus point for you guys. So basically, we also talk about a similar ratio, that is the PE ratio. Can anyone tell me the formula for the PE ratio? First of all, what is PE ratio? It is the price to earnings ratio, right? So what is PE ratio? Can anyone tell me the formula of the same? If you said it is MPS, that is the market price per share, divided by the EPS, that is earnings per share, you guys got my thumbs up. Okay, so what is PE ratio? PE ratio is the ratio of market price per share to the corresponding earnings per share. If we say that the PE ratio is higher, it means that the market price per share is higher, whereas the earnings per share is lower. Basically, what is happening, that what is market price? It is the price that investors are paying. Rather than writing investors, we should write that the shareholders are basically willing to pay, are willingly paying, are willing to pay rather, right? Are willing to pay, right? This is the market price per share, right? Basically determined using the market forces of demand and supply, right? I hope everybody knows that, right? And what is EPS? Earnings per share, basically representing what actually is the company earning for the shareholders. A high PE ratio basically means, at first instance, we may conclude that the higher PE ratio basically means that we are paying more to earn less. What I said, we as a shareholder, we as an investor, we are paying more to earn less. So basically, what we are doing, we are basically, at first instance, what we are doing, we are showing an irrational behavior. But is it really the case? Is it really the case that a higher PE ratio is indicating that the stock is overvalued? Nope. A big no to this thing. A big thumbs down. Why so? It might be a case, I would say so. It might be a case, but it is not always the case. Why so? Because, say for example, there's a company that is having a future prospect, that is having a future growth prospect, and for that growth prospect, they are investing their big chunk of money. They are investing a big chunk of money in a project, and because of that investment in that project, we are believing that the company is targeting for a future high growth potential. The company is a high growth potential company, right? So does that mean, so basically because of that investment, because of that particular project, the company is basically investing all its time, its efforts, its manpower to that particular project, thus affecting its current working potential, right? So basically thus impacting its current EPS. But because of that future growth potential, the people are valuing the market price per share of that company at a higher rate. Although its EPS is lower, but they are valuing its share price for the near future, I would say so, for the near future at a higher price. Since they are valuing the stock price in the near future at a higher price, it is affecting its present market price per share, right? So now comes the point, which ratio is better, PE ratio or the PB ratio? So both ratios individually have different significances, so there's no sort of comparison. Just one thing, that PE ratio, it can be negative. Why so? Because sometimes the company might not be earning something, the company might be losing out huge chunks of money, thus resulting in a negative EPS. And because of the negative EPS, the PE ratio can become negative. But this is not the case with the PB ratio. PB ratios are always positive. It can be positive, it can be negative. Okay, which ratio? The PE ratio can be positive or it can be negative. But when it comes to the PB ratio, it is always what? It is always positive, because book value per share, neither the market price can never get a negative sign in front of them. But this is not the case with the PE ratio. Why so? Because the EPS, they can be negative. Earnings might be negative in the situation, in the case when the company is not earning anything, when the company is basically burning its cash reserves, right? So I hope this clears your doubt. So this ends our video. I hope you liked it. And I always say that the finance is the learning of earning. So happy learning, happy earning. If you find this video valuable, helpful, so make sure to hit that like button, subscribe, and hit the notification bell so you never miss an update. Until next time, stay safe, stay healthy. Happy learning, happy earning, happy investing.